Hello, everybody. Dr. Richard Smith here, Executive Chairman of the Foundation for the Study of Cycles. And it is great to be with you again today here on Cycles TV, where we are going to be talking about bills, bots, and booms, because we've been studying the Federal Reserve and the liquidity plumbing system of not just the US, but the global financial system for the past couple of months, in our quest to understand when we're likely to see the cracks in the system, understand how the markets work today by looking at the biggest driver of events in the financial world today, which is, of course, the federal system, both the US Treasury and the Federal Reserve. So we study the cycles, but we look to see what's happening with the plumbing in the system in order to understand when those cycles are likely to really have their say, so to speak. So hopefully you've been following along today. I've got some interesting new insights to share with you. I think you'll find it very interesting and educational, help you better understand what's really going on in markets today. So we're going to get into that in just a minute. I want to give a quick shout out to the outstanding work once again of Lars von Tienen here on Cycles TV yesterday, covering some incredible dynamic cycles analysis of the El Nino temperature anomalies, which of course have huge impacts on weather, and that weather have big impacts on GDP. So really fantastic work from Lars. I hope you'll check that out. And exactly the kind of work that we want to do more of here at the Foundation for the Study of Cycles. So one other quick note, just a little appreciation to the W. Clement Stone Foundation. So if you all look in the, let me grab it here, Dewey's book, in his acknowledgments, you know, the Cycles, the Mysterious Forces, which we brought back into publication. I think here in the in the acknowledgments on a grant of $500,000 from the W. Clement and Jesse V. Stone Foundation made to the Foundation for the Study of Cycles. So I am thrilled to share with you all that the W. Clement Stone and Jesse V. Stone Foundation are still in existence and recently made a donation, not quite that large, but to the Foundation for the Study of Cycles. And it's just very encouraging that we are doing the work to bring the incredible work of the Foundation back to the public in a, I think, high integrity way, dynamic way. And it's great to have that work recognized by one of the original major supporters of Dewey and others at the Foundation. So excited about that. And last thing before we jump into actually looking at some charts that I think will interest you. We do have a few spots open in the Masters Working Group. This is our highest level of engagement in the FSC this month only. And we got 6 spots left. Lately, we've had Larry Williams, Jake Bernstein, Michael Howell join us as guests. And just the members of the Masters Working Group are off the charts too. So if you're interested, please do reach out to us. We can set you up with a consultation to learn more about it with Dr. Barton, our incredible colleague here at the Foundation. So love to have you involved with the Masters Working Group if you want to be involved with the Cycles think tank, par none. So, all right, let's get into the markets, see what's going on, see what's happening here with the Federal Reserve and how we can understand markets today. So let me just give me a second to put this all in order. Okay, so here is a new chart for the week. And the big event, as far as I'm concerned, of the past month has been not that the Fed cut rates by 25 basis points, not that Powell said that he might not cut rates again in December, or that it's not a given. The big deal is the end of quantitative tightening. Okay. So what Powell said was that they're going to stop the quantitative tightening, right? So remember on the Fed's balance sheet, we have treasuries of different durations, right? From bills, notes, bonds, and mortgage-backed securities. That was a first for the Fed to start buying mortgage-backed securities during the Great Financial Crisis. And that was just a defining event in the history of economics and markets for the Fed to do that. And we've been living in the aftermath of that ever since. So the gold line here is the Fed's balance sheet. We can see it peaked at close to $9 trillion back here in 2022. And that's on the left axis here. Hopefully you can read those numbers. I know it's kind of faint, but what we've been seeing, is the quantitative tightening going on here for the past few years, right? So the Fed's balance sheet has shrunk from 9 trillion down to about $6.5 trillion. And the Fed has said, that's enough. Even though the balance sheet was something like, $40 billion before this incredible balance sheet inflation began. Now it's gotten down to 6 trillion, down from 9 trillion. I guess we should feel good about that. But they at the last news conference, Powell told us that they're going to stop the runoff, okay, and start buying new treasuries to replace the treasuries that are maturing. And the blue line here is the treasury debt, okay, 100 trillion. And, just going up and up and up through the Biden regime and the Trump regime, nothing changes, okay? So treasuries have gone up and up and up, right? And this isn't stopping, okay? We have to keep, we have a deficit that we're still running. There's going to be more debt issued by Treasury. And though that debt has to be continually refinanced, okay? Because some of it matures and it has to be refinanced. So the other thing that Powell said was that he wanted to align the Fed's balance sheet with the Treasury's issuance regime. So the kind of mix that Treasury is issuing of bills, things that are less than a year, notes 1 to 10 years, and bonds 30 years, or 10 years to 30 years, right? So as the Treasury, issues more bills, right, and less bonds, the Fed wants to also bring its balance sheet into alignment with the Treasury's mix of issuance. So let's look now. Here's another new chart. Looking at roughly, what percentage of the Treasury's holdings are in bills, notes, and bonds. That's in blue here. So about 27% in bills, closer to 50% in notes, and maybe 26% in bonds. So this is the Treasury's mix. Meanwhile, here is the Fed's mix. So they're short on bills and they're longer on notes and bonds. So, why did that happen? Okay, because as the Fed let its treasuries mature, right, the shorter ones matured faster because they're shorter. So the Fed's runoff, QT has basically been shrinking these short-term bills, okay, and not so much the notes and the bonds. So when Powell tells us that he wants to bring the Fed's balance sheet in alignment with the Treasury's issuance regime, what he's telling us is that the Fed is going to be buying more bills. Okay. So that's important to note. We looked last time at the relationship between the Fed's balance sheet and the Fed funds rate. So now that this balance sheet is going to flatline or maybe even go up a little bit, we'll see. It likely does mean fewer rate cuts from the Fed. So that continues to be an issue. And we've seen the Fed's balance sheet, and then here are the reserves that the banks have at the Fed. Somewhere around the 3 trillion level now, I believe. So this is all part of the Fed plumbing that we've been studying, and we know that the reserves now are that the money market funds, et cetera, have at the Fed are quite low now. So there's not a lot of extra cash out there. The going rate for overnight cash that's secured by treasuries, about 3.93%, and coming down, right? So those treasuries have not been as good a collateral lately, and that is a bit of a concern. And then the interest rates, that the Fed pays the banks 3.9%. So those are quite close now. And when we look at the SOFR minus the IORB, I know if you're just joining me for the first time, hopefully you can go back and watch some of the earlier episodes. But basically, this is kind of what the overnight rate for cash is when you can collateralize that loan with treasuries versus when you don't, okay? And we're getting quite close to the zero line here, and it's come down a lot since October 31st, right? So that treasury collateral has become less valuable. And if we look at the bond volatility index, the so-called MOVE index, okay, we can see also that it started rising on October 31st. So bond volatility has been going up, still at quite low levels, but this is definitely turned up. Momentum is turning up. So as bond volatility has gone up, or treasury volatility, okay, we've seen the collateral of treasuries become less valuable. And so now that's getting low and almost at the same level as what the Fed pays the banks without treasury collateral. So that's getting to be a concern. And this is all part of why the Fed said that's enough tightening. So the bond volatility is going up a little bit. Here's the high yield, the volatility, and the spreads on the high yield debt as well. That's going up too, right? So we're definitely seeing some pressures in the liquidity area, which is why the Fed has ended QT. And then the Fed has told us that they want to also start to align their balance sheet with what the Treasury's issuing, which means they're going to be buying more bills. All right, so that's the picture in terms of the Fed plumbing and what's going on at the Fed and what that means for where we're at in the liquidity cycle. It means more short-term liquidity from the Fed in bills. So the title of my talk today was Bills, Bots, and Booms. Okay. So the reason I bring some of these other topics in is because the Fed isn't the only one buying short-term treasuries. Money market funds in the United States, which total about $7 trillion, are legally obligated to buy treasury bills. So this is another area where the money market funds, the cash, right, that you go to your bank, you get a CD, a money market fund, right? CDs aren't the same thing as money market funds, so my mistake. But you get a money market fund, you earn some interest on your cash. That's about $7 trillion, and those money market funds have to buy treasury bills. They're legally obligated. So they're buying treasury bills, okay? If we go back here to the chart that started us off today, you know, as this line climbs and as this one levels off, the Treasury is going to be issuing more bills and the Fed's going to be buying more bills. The money market funds are buying treasury bills. And stable coins, we've talked about this as well with the new Genius Act, I believe it was. Stable coins like Tether have to also buy treasuries to with their dollars, right? So they have to back up that they've got the assets there to, you know, turn the crypto back into dollars when needed. And to do that, they do it by buying treasuries. And now, finally, we have Sam Altman and his lot who are creating massive new pools of debt through the AI data centers. And guess what? That debt is also being part of the flow that is also buying treasuries as they go out and get, you know, loans based on that debt, etc. All of it is going into this big fiscal dominance of how does the Treasury keep refinancing the debt of the United States? The debt that isn't decreasing, right? We don't have we still have a trade deficit. We still have to refinance the $100 trillion of debt that we've already got. And these are the mechanisms that are doing it, right? So the Fed stopping its balance sheet runoff, buying more short-term debt. Money market funds buying treasury bills. Stable coins like Tether buying treasury bills. All this massive debt being generated for the data centers and AI CapEx build out, contributing to the flow of buying treasuries. So that's what's going on. And that is what's driving markets today. And this is where we need to be paying attention to see, you know, how much longer this can go on. And again, you know, we're seeing some increasing volatility in bonds, which makes those treasuries less valuable as collateral. We see that happening here with the standard overnight financing rate minus the interest rate for banks getting close to zero, coming down, and the cycles indicating that it could well come down further. So that's the story behind the scenes. Let me stop there for a minute. And see if you're tracking me and if you have any questions so far. So thanks for joining us. What are we, about 20 minutes into the show here? Dan, hello from Germany. Umberto, thanks for joining us. Mark, fantastic. Appreciate everybody being here. So I hope that we're getting an understanding of how markets work today, and that it's mostly about sustaining the unprecedented debt levels, right, of the U.S. government through the plumbing system. That's what's got to keep flowing in order for everything to keep flowing. So that's why we're looking so closely at how the global financial system plumbing works. And it is a cycle, right? So it helps us to understand what's going on with the cycles in the real world that we're seeing on our charts. All right, so with that, let's go now and look at some of the cycles in the assets that we care about and see where they're at and see how we can relate this to what we now understand about what's going on in the cycle of liquidity and plumbing for the global financial system, which is moving more towards the short-term issuance through the Fed, buying more short-term bills, money market funds, stable coins, and the AI CapEx regime, bills, bots, and booms, right? So my belief is that, we're going to see some volatility, but that we'll see, but I think unless we see real cracks in the system, we're likely to see more short-term liquidity flowing into the system, which will probably mean risk on for the end of the year seasonal and into 2026. And then the big questions will still be with us, and we'll be watching carefully for when those cracks start to show. All right, so with that, let me know what you would like to look at, and we'll go ahead and take a look at some cycles. I'm gonna pop over here to my proprietary dashboard so that I can get to some of the things that I like to look at easily. We see here's my equities group, E-minis, NASDAQ, Russell, Dow. And this is the daily column over here between the stability and the dominant cycles. And we can see, a fair amount of red here on the daily cycles and even the weekly cycles in equities. Over here, we see Bitcoin and Ethereum looking a little less bad. But let's go ahead and start with looking at the daily cycles, particularly the stability cycle on the S&P here, the E-mini S&Ps we've known for a while. Okay, we got this strong cycle here, 198. We've been following this for a while, momentum declining. This doesn't bode well for a blow off top, does it? The momentum's declining here. Meanwhile, if there's going to be massive new liquidity at the short end of the treasury curve, because the Fed's stopping QT and money market stable coins and Sam Altman are all also buying treasury bills, I think that could slow, if not slow, the decrease here in the cycle. But we'll keep a close eye on this, and we can go look at some of the shorter term time frames as well, like look at the hourly data on the S&P 500, for example. Okay, and if we look at the hourly data, we see that there's a clear cycle out here at 362. There's also a cycle here around 90. Stability is not as good on that, but overall, this is on the fairly bullish side based on the hourly data. So just because we see this, on the daily data doesn't mean that the sky is about to fall. we have to look at how all these things fit together. Okay. If we look at the NASDAQ here, okay, very similar to the E-mini S&P, right? Got a pretty clear sell signal here on the daily. Wouldn't say momentum has declined dramatically, but definitely a sell signal on the daily. And if we go down and look at the hourly data on the NASDAQ, similar to what we saw in the E-mini, no surprise. But this cycle here, also a longer cycle, pointing up. And after a pretty solid momentum buy signal there on the NASDAQ and the hourly data. Yes, we're getting a pullback today, and we'll see. Personally, I wouldn't be surprised to see some higher levels over the next week or two. And we are in the most bullish time of the year after not having a very big decline so far from the all-time highs that were made back in October. Okay, I know it felt like a lot here, but this is not a huge decline. And we had a massive up day yesterday. All right, if we look at Bitcoin, definitely been some downside pressure here. Looks like, at least on the daily data, maybe coming into a cycle bottom, but we'll see. If there really is liquidity coming to the short-term end of the markets, that could be a boost for Bitcoin. And we're seeing, a potential cycle bottoming on the daily cycles. Meanwhile, momentum still going down, not out of the woods yet. But if the Fed is, actually, I have a chart on this that's pretty interesting. I think it's this one. Yeah. So here we see the reserves that banks have at the Fed down now to about 3 trillion here, but it's pretty interesting how they track the price of Bitcoin, right? So look at this top end Bitcoin here, and then the reserves kind of coming down. That's liquidity coming out of the system, right? Matching the bottom end Bitcoin back up. So this has been a divergence here with Bitcoin going up while the reserve balances are actually coming down. We'll see, if Bitcoin is going to correct more or if the reserves are going to start coming back up. And based on Powell's latest comments, my suspicion is that the reserves are going to certainly level out, if not start to come back up. And we'll see how this divergence between Bitcoin and the reserve balances at the Fed resolves. But that by itself is a pretty compelling correlation between the reserve balances at the Fed and Bitcoin. That, and then we've had this divergence over the past year with Bitcoin going up, not falling, but meanwhile, reserve balances coming down. So something interesting going on there. All right. Let's look at short-term 2-year treasuries. Okay, these aren't T-bills. These are 2-year treasuries. Certainly good momentum moving up, right? A pretty clear cycle, 180 days. So again, like shorter end of the curve, good indication of continued strength here, and at least as short as I've got, which is the 2-year. So T-bills, 2 years, the shorter end of the curve, expecting those to get support from the Fed buying the bills, the money markets buying the bills, the stable coins buying the bills, right? And all of the new debt issuance that's coming with this AI CapEx build out, creating more demand for the anchor asset, the anchor collateral of the financial system, which are US treasuries. I saw another thing recently. I don't have it here right in front of me, but let me just go back here and leave the screen here. Okay. That the carry trade is back. So remember when we all thought the sky was falling with the carry trade, I don't know, a year, 18 months ago now? Well, the carry trade is back with a vengeance and doesn't seem to be going away anytime soon. So we're really living in a treasury and Fed driven liquidity regime now, particularly since the global financial crisis plus COVID. It's a synthetic, artificial financial reality, but that is the reality that we're living in. So it is reality. And I'm not seeing big cracks in the system yet, although we have seen some pressure. But the Fed is responding to that pressure by saying we're going to end QT and start buying treasuries again. So that's kind of what I see is where we're at and what's happening. Anna would like to look at USD. Okay, we can do that. Sure thing. And Mark, do you have a preference for either 2 or 3 cycle spectrum selections on daily for best accuracy? My strong preference, Mark, is for the #1 stability cycle when I can get it. So if I see a good, clean cycle with the highest stability score, and if it also has the highest rank, the AI rank, which is the AI that interprets the spectrum, then that's what I anchor everything off of. If I see a harmonic relationship between cycles, I'll look at them together. But I really like to find one main cycle and then maybe look for a couple other cycles that support it. Hello, Fritz from Oregon. Thanks for joining us. All right, so I think the dollar is a good one to look at and end with. So let me jump back over to that because it is the right question to ask. So where is the dollar on here? Yeah, okay. So we'll start with the daily cycles on the dollar. And we see we've been tracking this for a while, actually. Pretty good upside momentum in the dollar. And we had a new low here briefly without a new low in momentum, right? And then we've been on a pretty good up move from 96 up to 100. Okay, so that's a significant move in the dollar. Right now, we're focused on this 297 cycle that's out here. I'd want probably a little more data to have more confidence in that. So let's add another couple hundred data points and integrate that into our analysis. Yeah, so that's shown to be the stablest cycle. Okay, it's got the highest stability score. For some reason, let me go to profile 1. There we go. So yeah, it's got the highest stability score and it's got the #1 rank. So going back to Mark's question, and we can turn on the cyclic RSI and the swing momentum. Definitely have a little pullback here in momentum based on the swing momentum. But look at all these higher lows and momentum here, right? So we could get a pullback short term in the dollar, and we can go look at some shorter term cycles in the dollar. Actually, let's go down to the hourly cycles in the dollar. Right, we've got clear, strong cycle here. Let me get to my at 195. So on the hourly, definitely have the momentum coming down, right? I'm not out of the woods, but we're coming into a very stable cycle bottom here. We also see this 89. I don't think I would quite use that because the stability just isn't there. So I think in terms of the dollar, on the hourly data, we see some continued momentum decline, so I wouldn't be surprised to see this pullback continue a bit. But if we look at the dailies, expecting dollar strength into February or March. So great question, Anna. Thanks for the question. If we do get a good pullback on the dollar, I will certainly be looking to be a buyer, or maybe short the euro or the yen. So I think that's a pretty good picture of what's going on, folks. Just want to remind everybody that we do have a few slots open in the Masters Working Group. And if you would like to learn more about the highest level of engagement with the FSC, with an incredible group of minds and off-the-charts guest speakers, the MWG is the place to be. So please do reach out to us. You can meet with Dr. Barton to learn more about the opportunity. But thank you for joining us. Check out Lars's incredible show from yesterday if you haven't. Excellent stuff. And see you again here next week. But we're keeping a close eye on things, but it looks like the liquidity spigots are going to be turned back on here soon. So with that, thanks for joining me, and I'll see you again next week.